In this video, I want to discuss the different ways on how somebody could buy an annuity, why that might be helpful for their specific situation to accomplish their goals, and then more importantly, when it's a terrible scenario and when somebody should really avoid annuities altogether based on what their goals are and what they're looking to accomplish. So the first category is the what, why, and how. First off, what is an annuity and how can you leverage this sort of insurance product to accomplish your need if you're looking to produce some sort of lifetime income stream, if you're looking to just leverage it as an accumulation play, a safety from downward market losses and get consistent growth, and then also leveraging a non-qualified type of annuity for a tax-deferred play where you could still be leveraging your money in different investments, but make sure that it's underneath a non-qualified annuity chassis. So to break down each scenario, first we look at income. And an individual, what typically happens is there's two sides of financial planning. You have one side, which is the wealth accumulation side. That means that an individual is trying to work for a company or own their own business. They're trying to accumulate dollars and accumulate savings and trying to make those savings grow to beat out the pace of inflation so that they have a nice fat bucket that's sitting there when they want to retire. So when they no longer want to work, they no longer want to own the business, whatever that case might be. So now as these monies accumulate, they're trying to have the combination of contribute into this bucket, into this retirement account, and get a favorable rate of return into this account. So we have the combination of compound interest, which is trying to grow that bucket fatter and fatter and fatter. During your wealth accumulation stage, an individual is typically always trying to be on that growth mindset. How do I get the highest possible return, the highest possible return? Well, the opposite side of the coin with financial planning has to deal with wealth preservation distribution. When this bucket is nice and fat, how do they know or what sort of strategies should they leverage to make sure that they are not outliving their retirement savings, taking out too much money too quickly, still staying invested in the market or still staying invested with some sort of risk that could deplete this account and have the power of compound interest work negatively against their accounts so that they might have to go back to work much later on in life because they burnt through all their assets because they took either too high of a cash flow or they did not create the proper strategy. Income-related annuities could be beneficial towards this type of scenario. And reason being, or kind of the mistake that's made typically when somebody's looking to place their money in an annuity or with an income-related annuity is they're thinking that it's going to do all these amazing things, this jack of all trades type product. And in order to leverage any sort of account the right way is you have to say, okay, how does this maximize my situation? How does this benefit my situation? And then making sure that you're placing the smallest amount of dollars and only as much as necessary into that account, leverage that account to produce you what you need it. So sounds pretty simple, but a lot of people, they get overcomplicated and they trust a lot of advisors that just kind of say, oh no, it's going to do this and this and this. And by the end of the day, by the end of, 2, 3, 4, 5 years out, they realize, oh shit, I was in a really bad product, and now I don't know how to get my money back because I unfortunately messed up, 5 years prior. So that's obviously what I'm going to try to explain to you is try to not make this mistake, and then how can you make sure that you're calculating the proper dollar amount towards if it's an income play, setting up that way. If you want to just have it as a safe accumulation play, setting up that way, or avoiding it altogether. So there's three main ways on how somebody could pull out income from an annuity. The first way is known as annuitization, and that's how old-fashioned annuities were set up and really where annuities got a bad rap. Reason being is because annuitization, it requires, similar to if you think of it conceptually like a pension plan, if let's say you're offered a lump sum pension option like a buyout option, or you could take a lifetime income stream, which one makes more sense? And it really just depends upon that individual situation. So like, as an example, if let's say somebody was set up in a pension plan and they were either able to receive $500,000 of a lump sum, or they would be able to receive, let's say, $2,000 per month of lifetime income, what are the difference between those two? Well, 500,000 allows an individual to take the monies and try to invest this on their own, try to create an income strategy on their own. When they're taking let's say if this was a single life monthly income option, then this individual would receive $2,000 every month to the day that they passed away. And this is just a hypothetical example. So I'm going to tie it to how you could think of this conceptually like an annuity. But with this $2,000 per month, we understand if let's say the person only lives a year, they would have been paid out $24,000. Let's say, God forbid, they passed away after that year. Well, then nothing is getting left over to the beneficiaries. That's if somebody took a single life option. If let's say they took the 500,000, they were trying to take out $24,000 per year. Well, if all things being equal, they would still have $476,000. That if this person, God forbid, passed away, $476,000 would have went back to their beneficiaries, so they would have left some sort of inheritance. This is why individuals do not like annuitization, is because it's kind of that lump sum option. Let me control the chips versus, okay, let me just receive an income stream that the insurance company's going to tell me that I could receive. So what I mean by that, if let's say you had $500,000 that was in your annuity, and the insurance company says, okay, well, if we want to have single life income and you want to annuitize this contract, you could surrender all this $500,000 to us, and we'll pay you $2,000 or $3,000, every month to the day that you pass away. If you pass away within a couple of months, well, the insurance company kept all those dollars. That was profitable for them. If let's say you kept living and living and living and living and living, and you exhausted what that break-even point was, that you would have outlived that 500,000, well, then that was obviously a win for the individual. The problem with annuitization is that you lose control of your monies. You lose control of your chips. So this is why after you had something known as income riders came out, first they came out with variable annuities, and then fixed index annuities stole that concept, and now they have more powerful income riders on fixed index annuities known as hybrid annuities that will allow somebody to kind of think of it as have your cake and eat it too, but that sounds more gracious than what it really is. So what do I mean by that? So the other way on how somebody could receive lifetime income, not annuitization, not leveraging the annuitization provision, but leveraging it as per, how they set up that sort of account with the income rider feature that was attached to that account. Let's say if we had 500,000 that was sitting in, annuity number one, and this person was being offered to annuitize this contract for $3,000 monthly single life income, or you have annuity number two that has 500,000 sitting in this account balance, and the insurance company, because that income rider has been rolling up and the calculation based on it would provide this person $4,000 of monthly lifetime income. This is already a higher cash flow, a higher lifetime income amount with, annuity option number two in this example. Let's say they turn on this spigot, $4,000 per month of income. If let's say they live for a couple of months and they pass away, anytime that they're taking out income from this, it's going to reduce the account balance proportionately. Each time that they're taking a distribution, it's going to reduce this $500,000 amount. But if they were to pass away, whatever's remaining in this account balance would get left over to beneficiaries. Over here, if they took the single life option, and this is still less of a cash flow, if let's say they're living, they pass away, whatever's remaining in the account balance does not get left over to beneficiaries. So let's say if we fast forward and we go with this option number two, where this person's taking monies, and all of a sudden they exhaust their account balance, and their account value hits $0. If that happens, the insurance company is still on the hook to keep paying that $4,000 of monthly income. This is a lifetime income rider. This one is a lifetime income rider as well, but is a lifetime income payment. But with the lifetime income rider, this typically produces a higher cash flow than one that gives you no control of your monies. Also, they have certain get-out options because there's an income rider attached to it. If you want to cancel the income rider, majority of carriers allow you to do that, and you could also surrender your policy. If you surrender your policy within the first 10 years, you might incur surrender charges. Typically after 10 years or after 7 years, really depend upon how long that account was set up for in the decreasing surrender schedule, you could be able to walk away with these dollars if, let's say, there was a better opportunity that came about. So this is where I would say you could have your cake and eat it too. You could have that cash flow that you need to suffice your retirement expenses, but if you want to walk away and you want to have that get out option, you do have that option available with the hybrid annuity that you would not have with that annuitization when you execute that annuitization provision. So a quick example on how somebody could use an annuity for an income play, placing the smallest dollars only as much as necessary, is trying to figure out what their individual cash flow need is. If we have aggregated assets of 500,000, and an individual has an expense gap for their retirement needs, basically their retirement expenses of $30,000, Well, how much of this 500,000 total bucket aggregated of all their accounts will we need to place into some sort of income related account that will produce the lifetime income stream of $30,000 every year to the day that this person passes away? So that all is based on cash flow. You might have over 1,100 different companies, contracts, products that are producing some sort of lifetime income stream in the form of annuities. Why would you go with 20th place or 10th place when you go with first place, second place, or third place? So what I mean by that, if let's say the first place option only requires an individual to place in $350,000 into the first place option that will produce the $30,000 of income, for second place that requires $420,000 to produce that same $30,000 of income, let alone in 15th place or 20th place, which might need 600,000 to place into an annuity account for that same $30,000 of cash flow. Why would you go down the road, or why would you go down to second place, third place, fourth place, fifth place, whatever that is, as opposed to going with the first place option if you have the same ratings of the carriers, if you have the same protections in place? Why would you place more money into an account if you don't have to? So this is where, by using the smallest dollars only as much as necessary, in this example, an individual can accomplish their income related goal by and still have $150,000 left over for their emergency need, for their growth related need, for their legacy need, whatever that case might be. That will complete what their actual financial plan is designated for. So I hope that that quick example makes sense. Where that doesn't make sense, and really I'm going to kind of dabble on the common mistakes with this, but let's say if somebody is receiving pension income of $50,000, Social Security income equals $30,000, and after doing their budgeting analysis, we understand that this individual only has expenses of $55,000, but they're receiving $80,000 of lifetime income. That's obviously a large spread there. That's $25,000 of net cash flow that they're receiving above what their minimum expense requirements are. So therefore, why would anybody place more money into an income-related product if they don't need to have more income? So that's where a very common mistake is. Somebody would just see a shiny object and they would look at an income rider and the roll-up rate of an income rider and think that they're actually getting that return on their physical money, and that's not the case. An income rider is nothing more than a calculation account. It calculates how much lifetime income that you would receive. If you don't need lifetime income, you don't need more lifetime income than what you're already going to receive, then why would you place your money into an income-related product or an income-related annuity? So I hope that this makes sense. The other option is, let's say if somebody is wanting to receive a consistency on their physical money, they have some sort of growth on their monies, but they don't want to have downward market losses and they don't want to have fees to hinder their account balance. So like as a common example, let's say if somebody set up with a moderate portfolio and they're in 60% stocks and 40% bonds, thinking that their portfolio is safe because they have this bond related play. But depending on what sort of bond portfolios that they're set up in, if they're set up in junk bonds or high yield bonds or long-term bonds, as interest rate environment is going up, and they're noticing that they're actually receiving negative values to their bond accounts, what might be a solution for that to say, well, I just don't want to have any negative. I don't mind having 60% of my portfolio in some aggressive related play, but I want to make sure that this 40% portion is designated for no fees and no downward market losses, so that worst case scenario, I'm going to gain 0% of my dollars if the market's crashing. What might be a solution there? So this is where individuals have leveraged naked FIAs, where I deem the term naked fixed index annuities, because it's just essentially a fixed index annuity without any sort of bells and whistles, without any sort of income riders or death benefit riders, any sort of fees that are coming out of that account and draining that account. So from a conceptual standpoint, if you think of it like a bucket, we understand like any sort of account grows by the contribution somebody's making into the account and the rate of return. Well, if you went and let's say you took old 401k monies or IRA monies and you created an IRA related annuity, well, that could be a transfer from whatever that existing account is, and now it's sitting in an IRA account, but it's just sitting with an annuity related chassis. So with this naked FIA, it would essentially gain. So think of it like a bucket with a lid over it. It would gain each year that those indexes that are linked to that account go up, gain 0% whenever those indexes go down. Gain when those indexes go up, gain 0% whenever those indexes go down. So you're either going to receive a credit or you receive 0% a credit or 0%. Now be mindful, it's not going to have the same growth opportunities that you would with leveraging individual investments. So from a growth play, I say it's more towards that consistency standpoint. So something that you're just looking to have a consistent rate of return on your monies, but not have that downward market losses or the fees that could really, blow up a portfolio. Also, from an income perspective, we understand that an individual could receive income from an annuity through annuitization, which I don't like, through an income rider, which could be necessary in a situation, and then also from safe withdrawals from their portfolios with naked FIAs. So typically, some of these fixed index annuity contracts, with looking for that safe accumulation strategy, they allow an individual to access up to 10% of free withdrawals per year from their account balance, and that 10% could accomplish what that income-related need is for that year, while still leaving the remaining dollars to grow when the market goes up, gain 0% whenever the market goes down. So it could be a nice hedge off of making sure you're not falling victim to the volatility in the markets, to the fees with different expense ratios with traditional investments, and still be able to have a decent growth strategy in there. So that would be withdrawals would be really the third aspect of income. So if at any point in time, to kind of pause, at any point in time that you want to hear further information and see if there are solutions, there are strategies that would better your situation, feel free to give our 1-800 number a call. It's 1-800-566-1002. Reference this video, ask to speak to a specialist, and we'll make sure that our assistants will put you on the set you up with a calendar appointment. We can either set you up through phone call, through Zoom call, through face-to-face, depending upon your area. So we want to make sure to make things as easy and as flexible for you guys as possible. So I hope that all this makes sense. From a tax-deferred growth standpoint, be mindful that if something is an IRA, like when you're setting up your annuity, you could have this established as an IRA annuity, a Roth IRA annuity, or you could also create it as a non-qualified annuity. The monies that are growing in an IRA are already growing tax deferred. So it's not like placing it into annuity is going to give it any more tax deferred benefit. It's just going to stay within, it's just a type of IRA that is set up in. So if let's say you had $500,000, I'm just going to keep using that example, $500,000 in one IRA account, and you understand that IRA number one, or let's call it IRA number two, for an income play, you were needing $200,000 to place into there, and maybe you wanted to leverage IRA number three, which is set up on a safe accumulation play for $100,000. What exactly does this look like? Well, your original IRA number one sitting at $500,000 is now going to be sitting at $200,000. IRA number two is sitting at 200,000. IRA number three is sitting at 300,000. So you literally took one account and you spliced them up into three separate areas, but they're all growing tax deferred within those, IRA related chassis, and basically this IRA number one might be set up as a growth related strategy with different investments, different combination of asset allocations in there. IRA number two could be set up as an income play. IRA number three could be set up as a safe accumulation play, but all of it's growing tax deferred. Same concept with the Roth IRA. Everything's growing essentially tax deferred compound interest, but it's actually growing tax free because Roth monies will not be taxed when you're taking withdrawals from it. Now, the benefits of an annuity on a non-qualified account could be beneficial, but could also hurt an individual if they don't understand this properly. What do I mean by that? The most basic example would be leveraging a bank CD versus leveraging a fixed annuity. So let's say if we had a bank CD that was paying an individual 2% and it was in a 5-year bank CD, and let's say that this person was 55 years old, and they put $100,000, really easy math, with a bank CD that's paying 2% per year. So this means at the end of the first year, this individual would have received a credit of $2,000. They would have to pay a 1099 as if that was interest that they received for that year. And then the next year would be another $2,000. The next year, another $2,000. But each year, whether they spent that money or not, they have to pay a 1099. They have to pay tax on those monies that are growing if they're sitting in a non-qualified bank CD. With a fixed annuity, if let's say you had a 5-year fixed annuity, and typically fixed annuities pay a little bit higher interest, so let's say it was 3% with a fixed annuity, that same $100,000, it's going to gain 3% the first year. The next year, it's going to be 3% of $103,000. The next year it's going to be 3% of that number. The next year 3% of that number. So after all 5 years, where the individual is now age 60, when that bank CD, the non-qualified bank CD, they'd be able to walk away with 100,000. With this account, they weren't getting dinged with that taxable interest each year. They weren't getting dinged with that 1099 each year. They were allowing this account to grow with the power of compound interest because the higher interest rate was growing compound interest on top of each other each year, and they weren't getting taxed on those dollars. So that's one way on how it could create a tax-deferred growth within an annuity chassis. Now that sounds fine, but let's say if this person's not 55 years old, let's say they're 45 years old, and they have that bank CD route that's paying them 2%, or they have the fixed annuity that's paying them 3%. And let's say after 5 years, this person's age 50, they're able to walk away with that $100,000. They were paying interest, they were paying that 1099 each year. This account is going to be valued if we have 3% compound interest on top of each other. This account balance would be $115,927. They have an extra $927 of more interest that compounded during that time frame, as opposed if you took all, actually these, if let's say you had a 3% bank CD versus a 3% fixed annuity, this would only gain $15,000. Because it was 2%, we understand that that was only $10,000 that gained during that time frame. So actually this one has much higher, about $5,927 of more interest that compounded. Now the negative to that is, let's say this one with the bank CD, they could fully walk away with their monies and reinvest it into something else. This one, because it's sitting in that annuity chassis, they're not 59 and a half yet. It's not an IRA, but because they're using it as an annuity chassis, yes, everything grew compound interest, power of of compound interest grew tax deferred. But if they try to liquidate this account, they could get dinged with a penalty off of the interest that they gain, anything above that cost basis, because they did not wait until 59 and a half to take it. So you want to be very careful when leveraging that strategy. Also, ways on how somebody could leverage that investment related philosophy in a brokerage account and say, okay, I want to have access to my monies at any point in time, but I hate that I'm getting dinged with a 1099 tax each year. And let's say somebody's in their 60s already and they're above the age of 59 and a half, they could use these no load variable annuities or these no surrender charge variable annuities to basically hoard their dollars within that non-qualified annuity chassis. So there's some carriers, there are limited carriers that allow this, but there are definitely some carriers that allow that kind of no load variable annuity route, which is a lot different than a lot of the variable annuities that I bashed before in the past. That I said, with income riders and 3 to 5% in fees, it's a lot different of a situation, altogether. So it's just something that you could leverage as tax deferred growth, leveraging the power of compound interest within your account. So I hope that all of that makes sense. Really, the common mistakes just to touch up on, if let's say someone's trying to use an account before age 59 and a half, that could really hurt their situation. So this is where somebody would probably not want to place those dollars into an annuity account. If let's say they know that they have a long-term related need and they like the concept of it, well then yeah, mathematically and scientifically, if it makes sense, then obviously move forward with it. If not, then don't move forward with it. If the benefits do not correlate to your needs, this is the most important aspect. One of the things that we have is we have a trademark process known as the retirement diet plan, where it takes the key areas of financial planning and make sure that we're dissecting every little area so that an individual is actually having a plan, not just a portfolio. Too often individuals just throw a lot of monies at portfolios and hope, they have that hopium that things will work out. What you want to do is have some sort of plan in place. So like the D in diet stands for distribution strategy, the I stands for investment or growth strategy, the E stands for estate planning or legacy strategy. If you want to leave monies to loved ones, how can you leverage these sorts of accounts with maybe death benefit riders that could grow favorably for an individual situation? And then the T, the tax planning, maybe you could do Roth conversions that are set up with Roth related accounts with income riders, so that income coming to that individual will be tax-free income. So there's a whole multitude of different ways. Also maximizing a rate of return. If somebody knows that they have a growth related need, and let's say that their risk tolerance is super aggressive and they're very risk tolerant, they're not risk averse, so they like the kind of the ebbs and flows of the market, well then an annuity that might be way too conservative for their position, and that might not be what that individual really wants or subconsciously wants. And that's something that even if mathematically it does work out that annuity should be in their best interest, if it doesn't correlate to their mindset, doesn't correlate to their goals, then there's no reason to go into that annuity account. The three thing scenario, which kind of help itemize whether or not somebody could place dollars into an annuity, is there's three things that every individual needs to figure out before they're retired, or if they're currently retired, how to stay retired forever. The first step is making sure that their income play is complete. That if they have a gap in income, how to make sure that they could close that gap, and will suffice that gap with leveraging the correct tools, like individual tools in the tool belt, using the smallest amount of dollars and only as much as necessary to do so. The next stage would be emergency, making sure that they have about 6 to 12 months of what their expenses are into some sort of liquid account so they could use it for an oh my gosh moment scenario. And then everything remaining would be go in step three, which would be their growth related strategies, really their fund monies, their kind of their dollars that they just want to try to grow as much as possible. And if the market does well with them and they have a high interest rate on that for that year, they could use that extra interest to go on a vacation or splurge a little bit, purchase a new car, whatever that is. So really it's all about hoarding the smallest dollars only as much as necessary in step one, which is income, so that you could have the smallest dollars only as much as necessary in step two. And then step three, the ultimate goal is to try to have as much money in your fund money, in your growth account. And that's where the three thing scenario come in. With our retirement diet plan process, that's just a sliver of what we do with an individual's portfolio. Once again, we do have minimum requirements with the retirement diet plan, but definitely feel free to give our 1-800 number a call. It's 1-800-566-1002. Typically, what we see is an individual will go and they'll have a portfolio. They'll go and they'll speak to an investment advisor. The investment advisor says, yes, you have X amount of assets. Go place it into these mutual funds or ETFs or stocks or bonds in this blend. They're charging 1 to 2% of an advisory fee, and they're just allowing it to grow, and it's going to ebb and flow with the market. That's not a strategy. That's not a plan. That's a portfolio. What we like to do is make sure that every little angle, every little area is covered. This three thing scenario, kind of what I dabbled up on, what I touched up on with the buying annuity process, that's just a sliver of what we do to make sure that it encompasses your overall plan. So you have that peace of mind if the markets are doing well, you're happy. If the markets go down, you're happy. If the market's going sideways, you're happy. And that's what we try to make sure are covered with our retirement diet plan process. At any point in time, feel free to write a comment, give a thumbs up, subscribe to our YouTube channel, give our 1-800 number a call, 1-800-566-1002. And just let us know. Let us know what sort of videos that you want us to create further, and we'll be sure to try to help you guys out. I hope you found value in this. And by subscribing to our YouTube channel, you have access to the most updated videos. Thank you so much.